CFA Institute, which is a well-known chartered financial analyst institute, which is active all over the world. So without further ado, I would like to pass the floor to Imen, how they have seen markets evolving over the last 6 months, 8 months. And Imen, thank you very much for joining us and taking the time to explain to us how you see this from the perspective of the European Central Bank.
Thank you very much, Carol, and thank you for the nice invitation to speak today and debate with Alberto and Raul. So I wanted to start, before I start with the presentation, I just wanted to mention that you said something very important, which is that the channels by which corporates are supported in the financial system in the euro area are manifold, and they are mostly bank-based and capital market-based for the remainder. In the European Central Bank, the package that we put in place in March of this year to address the pandemics is very much working through these different channels. Yeah, so it's not only about the QE, although we will see the QE provides considerable support, but it's also through the bank lending channel. Yeah, so we put in place this 3-year operation, the TLTRO, which basically provides very favorable funding to the banks at -1%, providing that the bank meets certain lending targets in relation to lending to non-financial corporations. Yeah, and that's a very important channel for monetary policy transmission. Yeah, I mean, we've seen this record take up at the TLTRO in June of 1.3 trillion euros, which is close to 10% of European GDP. Yeah, and underpinning these TLTRO operations, there's also our Collateral Framework, which accepts bank loans. And that's a real difference to other central banks. I mean, we accept what we call credit claims, which is bank loans, including all these government guaranteed loans that have been given by governments. And this are most of the time given to, as you said, mid-sized companies, also SMEs. And this is a very powerful channel when you combine the TLTRO operations at -1% and this very broad collateral framework to make sure that all the chain of lending through the banking system is mobilized. Yeah. So now turning to the capital markets, which is the topic of the day, I just prepared a few slides, so I don't want to spend too much time on it, but I think it's useful to have a look at the figures. So I'll be sharing these with you now. And basically, let's start, if I manage, to the next slide. We immediately, with what we've done, as you said, in March, with the PEP program. So on the left-hand side, you see that since 2016, we are indeed active in a number of private sector bond markets, the Covert bonds market, the ABS market, and the corporate bond market. But really, the action taken with the pandemics has been quite extraordinary, and you see these bars on the right-hand side of this chart on the left, yeah, with especially this very strong support provided in March and April on the corporate bond market and the commercial paper market. And this commercial paper market experienced a lot of disruptions in March and April because companies that were used to access this market quite routinely and sell to their natural investor base, money market funds, could not do so anymore because the money market funds were themselves having redemptions and outflows. Yeah. So when we announced the PEP program on the 18th of March, we included commercial paper as a new asset class that we could buy in the PEP. And you can see on the right-hand side how the line marking the start of our purchases has then led to a support to the amount outstanding there in the market, and I think we acted very much as a backstop to some of these liquidations from the money market funds. And now, I mean, we've done this effort throughout March, April, and a bit of May, and now the situation has really normalized and stabilized, meaning that the natural investor base has come back, and most of the CPs that we have bought in that period and arrive for redemption are actually not rolled over at the moment, because the companies find more attractive conditions in the market with their natural investors. So it's typically an example where, you know, there's a market disruption, and then the central bank steps in strongly, but for a short period of time as a backstop, and then the market restarts a normal functioning. So then on the next slide, I just wanted to address some of the some of the issues that are raised sometimes with our QE program on the private side, which is that, you know, are you basically representing now a very large part of the market, and therefore is there still a true market and everything? And on the left-hand side, you see here how the investment grade corporate bond market in the euro area has grown since we started buying assets. And you see our share of this market in blue at the bottom. It's quite clear that our share of the market remains very modest, yeah? So I think more than anything, the purchases have acted as a catalyst in order to increase the size and the depth of the European corporate bond universe, yeah? And this is all, I mean, this is especially the case because when we buy these bonds, our guiding principle is mostly market neutrality, yeah, which implies to preserve market functioning and to be buying alongside the market. And you see that on the right-hand side, where you look at our holdings of corporate bond and you compare them to the universe. And you see that these two bars are very similar, yeah? I mean, there isn't any bias or distortion noticeable. And this helps that the purchases are conducted alongside, as I said, alongside the market. Turning to the next slide, I just wanted to give a little glimpse into the covered bond market, where our footprint in this market, which is a bit narrower market, has been larger compared to the other asset categories. But at the end of the day, we think that this did not result in any major impact on the functioning of this market. So we participate, you can see here the spread movements and how they correlated to our purchases. And we also participate in the primary market. You can see that on the right-hand side, where we have plotted basically what's happening on the issuance side, and there again we don't think that there's a kind of correlation between our action and the market trends. Then finishing on the last slide, ABS PP. So the ABS, that's really an interesting market segment because when we launched the purchases, the ambition there has really been to contribute to the integration of this market at the European level, yeah, and also to foster a number of other efforts that were being made by regulators, for example, with the publication of the new securitization regulation. And I think that we have achieved, this goal partly. I mean, the ABS market remains kind of a difficult one. It's a small one. But overall, the purchases of the ECB have contributed to primary market that is, I would say, sustained. So if you look at the bid to cover ratios on the left-hand side, they've been relatively stable both in the core market and the non-core market over time. But more than anything, if you look at the right-hand side, you see that the purchasers managed to increase the share of the non-core jurisdictions in this ABS market. Yeah, so we do facilitate indirectly the access of corporations in the periphery through the ABS market to finance. Yeah, and this is kind of the tribute to European integration. And just to finish on this note of European integration, which is very dear to the heart of the ECB, and I think we can stop sharing the slide at that point in time. The example of the commercial paper that we bought is also related to European integration, because we have asked that the CP we purchase hold the STEP label, so this label that has been agreed at the European level. And since our purchase has started, there are more than 30 issuers that got the STEP label. Yeah, so I think we have contributed to also accelerate this integration on this short-term commercial paper market. And I'll stop there. Thank you.
Darren, you're muted.
Yes, thank you, Iman. You said in the beginning that we acted rapidly to make sure that the markets could return back to normal. Have the markets returned back to normal? And secondly, would there be a need for an additional action by the ECB if we see that we see COVID and lockdown all over again?
I think that from the market functioning point of view, the markets have pretty much gone back to normal in terms of liquidity, for instance. Yeah, in terms of spreads in the investment grade space, there's also a return to pre-pandemic level. Now, I think that you're very right to say that what is not back to normal is really the state of the economy. Yeah, and clearly the anticipation for the last quarter of this year is for much lower growth than initially expected. For the moment, it's not translated into higher market tensions. But of course, as was also repeated by the ECB president, Christine Lagarde, at the last press conference, I mean, we have now this flexibility in the programs that help us to address any market disruption that would arise. Yeah, for the moment, we don't see that. But of course, we would be ready to address that if we see this happening.
Okay, thank you. We turn to Alberto. I mean, Alberto also wanted to share a few slides. So Beatrice, if you could make sure that we can do this, or Alberto wanted to do it himself. So we'll see what Alberto thinks about how he sees this from his perspective, as being a manager of a fund, but also a well-known commentator, as I said, on macro issues. Alberto.
Hi, everyone. Thank you for having me. My name is Alberto Gallo, and my main job is to run a investment fund which invests across the credit space, both in Europe and outside of Europe. So we buy corporate bonds and bank bonds and sometimes sovereign debt as well. And we have seen both at the investment grade and the higher level down to some of the smaller firms that finance themselves in the high yield market. So the European non-investment grade names, which are rated, double Bs or single Bs, and so on. So we can see how spreads and credit risk has been moving, before and after the COVID crisis across the spectrum of firms by size and rating. And also importantly, how the liquidity has been changing in the market. Now, one of the points that we was made before was that market conditions have returned to normal, which is true for the broader market. We see, stock markets very close to pre-COVID levels. In the US, they're even higher than that. And we see sovereign credit spreads even below pre-COVID levels. Italian BTPs are at near 60 basis points. Spain and Portuguese 10-year debt is close to zero, which was something probably unthinkable before the COVID crisis. However, if we look deeper down into the real economy, so into the smaller firms, the firms that don't have an investment grade rating, they're not directly targeted by the ECB purchase program, then the picture is a little bit different. And here I'm gonna show you one chart, which is this. I hope you can see it. It's the credit spreads on single B firms in dark blue in Europe. So these are firms that are generally mid-cap, small caps. They don't have access, they're not investment grade rated, they're relatively small. And compared to Italian sovereign debt and Greek sovereign debt, so the riskier part of the sovereign debt market, which is targeted directly by the purchase program. And so what you see here is that this is a normalized chart. So on the y-axis, this is a basis point chart. On the y-axis, you see the basis point level. So roughly speaking, they were quite close before. In percentage, you can see that the change in the basis points. So from 100 being before the crisis, single B spreads widened to 250%. So they widened 2.5 times, and now they are 1.5 times wider. On the other hand, spreads on Italy and Greece are roughly the same, if not lower. So it is true that market conditions have normalized for the liquid space, for the large issuers, the investment grade issuers. Apple and Microsoft can fund very, very well. Volkswagen can fund really well, and so are most of the large investment grade companies. However, when we go deeper down into things that are more closely linked to the real economy, we see a gap, and the gap is very substantial, and it's very clear from this chart. And this is because investors are very certain about the central banks being there, but at the same time, central banks are only there for assets that have relatively low risk. And sometimes the transmission from these assets with relatively low risks to the assets that require long-term capital, long-term investment, and that are assets that are riskier, this transmission is still blocked. And this is a picture of the bond market. Now, if we look at the banks, this is a chart from the ECB bank lending survey. If we look at the bank lending, it is true that the TLTRO take-up has been very high. However, part of the bank lending is done through mortgages and relatively low-risk loans. When it comes to lending to firms, there has been a tightening in lending standards. And if we look at the cost of capital for European banks, which currently trade at a fraction of book value, and the cost of funding for European banks, if we take subordinated debt, the spread that European banks have to fund at is roughly twice the one for US banks or Australian banks or Chinese banks. Then all these things tell us that European banks' cost of capital is still relatively high. As a result, the lending ability is relatively low. So essentially in Europe, we have a situation where capital markets are still relatively small. If we take a step back, we have a big opportunity to build on the fiscal union that is happening, to build a stronger and deeper capital markets union. However, capital markets today are still relatively small. Bank loans are bigger as percentage of GDP in Europe than in the US. But if we look at investment grade, yes, the market is growing, but it's still 1/3 smaller, for example, than the US. And the high yield market is roughly half the size, and the equity market as well. So capital markets are small, and also there is a gap between large caps between what is liquid, between sovereigns that are directly targeted by the ECB versus the real economy, so the small caps, the SMEs, which in Europe produce 80% of new jobs. And most of the SMEs fund through the banking channel. The second point is the banking system, which is 80% of lending in Europe, is still relatively weak. It's strong from a liquidity and solvency perspective, but the profitability is still relatively low, despite there's been a lot of guarantees against the COVID losses. Banks in Europe remain too large at 30 trillion euros, so 3 times GDP, 300% of GDP, so 30 trillion euros balance sheet, and they remain relatively unprofitable, which is also why they are relatively risk averse in making loans to the real economy, so the SMEs, and essentially more of the loan output has been going towards mortgages and other instruments, or even purchases of sovereign debt, which consume very little capital. So what is the solution here? I mean, obviously we need deeper capital markets because banks are too large, but it's going to take a long time to get there. But also we need banks to consolidate and to improve profitability, because otherwise a lot of the TLTRO liquidity tends to end up into low risk loans, which are, for example, loans for the purchase of homes or real estate, but eventually these are non-productive assets vis-a-vis purchases of assets that are linked to production. So it's a long road. Clearly, there is, in our view, there's been a lot of progress. Obviously, these spreads have compressed a lot compared to the pre-COVID levels. We went from 100 to 250% down to 150%, but the level of normalization is still something which doesn't tell us that we are back to pre-COVID levels. So I would say that there's still a long road, and maybe some thinking to make about how can we make monetary policy not only compress BTP spreads, but also with the help of government stimulus, also compress funding costs and help firms to refinance in the real economy.
Thank you, Alberto. I think that was very clear. You said you were a bit less outspoken than Imen, certainly in the sense that you said that the TLTRO was successful, but has not contributed that much to easing financial conditions, above all for the mid-caps and the smaller size element, which depends entirely on bank financing. Probably we'll move right away to Raúl Gómez. Raúl, who's representing Vidrila Group, let's say a Spanish mid-sized company, which has just been started to issue in the commercial paper market. He can say something about this and also can confront us whether he sees whether it's easy or difficult from the perspective of a Spanish corporate or small mid-sized corporate. Raúl, pleasure to have you here, and pleasure that you could join us at late notice, but also pleasure to have this real market experience from a Spanish mid-sized corporation which is active in the glass sector. You can probably say something about this. Raúl. You're on it, yes. It doesn't work. Raúl, your voice is not good. No. No, we don't hear you. I mean, what you can do probably, Raúl, for a moment, you go out and you rejoin, and then I can ask a follow-up question to Alberto, probably in the meantime, while you rejoin. Alberto, on the TLTRO, I mean, you said, of course, that was a very good remark from Imen at the beginning. Of course, we have not only acted directly in the markets through supporting commercial paper market, for example, but also the ECB has acted through the TLTRO. But you were saying that the TLTRO has basically gone to non-risky asset and has not really helped corporations or SMEs.
Thank you. So I think there's let me show you another chart. I think to correct the statement, I mean, everyone has been helped by the ECB actions, and obviously we would be in a much worse place without QE and without the TLTRO. I think the issue that we face, however, is that a lot of what we can observe from the market is that a lot of the monetary policy tools are a bit like a one-size-fits-all tool. So in order to help SMEs and productivity in Italy or Greece, the ECB buys sovereign debt, and then we hope that the sovereign will take the necessary measures to transmit that to the real economy, and that the banks will do that as well. In the US, where capital markets are deeper in high yield, for example, or levered loans, or even in investment grade, the transmission mechanism is more direct. So what's been happening is that if we look at the current distribution of firms in the high yield market, this is the comparison between the high yield CDS index in Europe versus the US. If we compare the tail of stressed names, today there's a bigger tail of names that are in a stress situation, and there's also a higher average of names, a higher average risk premium. So I mean, it is probably impossible to ask to compress these funding costs back to pre-COVID levels. However, the gap is persistent. And for example, in the US, the Federal Reserve has moved to buy fallen angels. So essentially, one of the things that has been done is to prevent ratings from becoming pro-cyclicals. When things are bad, rating agencies downgrade companies and they get out of the purchase program. So acting against this pro-cyclical rating cycle, rating behavior is an interesting thing that has been done in the US. But generally, everyone has benefited, but some people have benefited a bit less. And in part, this is because European capital markets, yes, they are growing, but look at the growth compared to the US, which is on the right side. They are still much smaller, and so the transmission mechanism is less direct.
Yeah, no, this last chart is extremely interesting. We see whether we can join back, get Raul on board, if it works. Raul?
Yeah, can you hear me now, Carol?
Yes, it works now. Thank you.
Thank you very much. Apologies for that. Well, thanks for your introduction, and thank you all attendees for attending this meeting. Well, I think that the experience of Ibala is just like the experience of the real economy, the experience of a traditional company. Okay, Ibala is a consumer packaging company. We produce glass containers for food and beverage products. The company obtains an annual turnover of approximately 1 billion for annual EBITDA of approximately 270 million euros. So the company is listed in the Spanish stock exchange. So we are what we all can consider as a mid-cap company, a mid-cap company that is in a process of learning, in a process of education. For a company like us, traditionally financing depends or has depended on banks, okay? We know that probably makes no sense. We know all that we need to diversify our financing sources. We need to take care more carefully to concepts like maturities, duration of our debt, but the bank is always a very easy solution for us, okay? Particularly in circumstances like this. But so in our case, we knew we needed for further sophistication, we need to explore different financing alternatives, and we decided to enter and to try the commercial paper system. And now, well, we have opened a door for a new space, for a new room for financing that is probably there forever, something that will be very relevant for us. We now have improved the cost base of our debt. We have diversified our financing sources, and much more relevant, whether our experience could be helpful for you, we have started a process of education. We know now how to deal with documentation to access credit markets. We know how to manage debt investors, and we know how to monitor more carefully market conditions. And this is huge for us. Okay, and we have now a more proper financing structure. This is just a starting point for us. Okay.
Could you add, let's say, probably how much you have issued on the markets, and also what you hear a lot is that SMEs say it's far too expensive to do this.
Yeah, we started with a small first transaction that was 8 months ago, approximately of 50 million euros. And this comment is relevant. Okay, commercial paper system is easy even for small transactions. Something that the small mid companies like us need. Okay, we normally are afraid about the credit market conditions because theoretically we tend to think that credit markets are exclusive for big companies, and this is not the case. Now we are issuing actively 150 million euros, something that probably comprises all our working capital needs. We are not using, obviously, commercial paper to finance our long-term CapEx needs. We are using commercial paper to diversify and finance our short-term financing needs, our working capital, and 150 million is basically all our working capital. Unfortunately for our banks, because we are substituting our banks, but the learning process for us is being huge, and that will be relevant for our future.
I assume you're not rated, meaning was this a problem? Not having a rating?
We are not rated, and this is an additional point that could be useful for traditional companies that need to take experience in credit markets, like small big companies like Vidrala. Okay? We tend to be afraid of when thinking on entering as first-time issuer to the credit markets. We tend to be afraid of things like direct cost, lawyers, advisors, documentation, investment bankers, and emotional cost, the credit ratings, what that could mean. And the commercial paper system is wonderful in that sense. It's a wonderful, easy to access a starting point. Well, that's our experience. In that sense, it's very easy to start conditions or to start deals in the commercial paper system.
Yes, very interesting. And was your acceptance of your commercial paper market large enough? Was it constrained to Spain, or did you meet a European market?
We took a decision of creating all documentation and engaging with advisors on a European level. And for example, all our documentation is made in English. And we are trying to accelerate the opening our debt investor base to a pan-European investor base. Okay? It's something that we are trying with some success. Obviously, the credit market conditions are in great conditions, at least for our experience now, probably thanks to the contribution of the European Central Bank and all the support that we are receiving for our authorities, and thanks to the help of our advisors, because things are being much easier than we thought initially. And okay, as a consequence, as a result of that, okay, we are saturating our financing in the commercial paper system, and we are opening the investor base to European investors.
No, very, very interesting, and I think many people should hear about your story. Certainly, if you say that it's much easier than you anticipated. I probably go back to Imen. Let's say if she wants to react to what she's heard, and probably to react as well to Alberto and to Raúl. Let's say on how she sees, let's say, the role of the European Central Bank. Imen, you were saying that the ECB was try to be neutral, try to kind of make sure that you were imitating the holdings within the market. Alberto saw some problems certainly in some more difficult segments, like in the B segment or in the segment which Raúl represents, even if they are not rated. Imen?
Yeah, well, I found it really interesting, the story of Raul, and how this basically learning process in order to access the capital markets, because I think that what we aim at is to provide in a way a kind of path for the corporate sector in general to know that there are ways indeed for accessing and being supported in this market. We cannot support, as you said, our purchases are limited to a part of the market which is investment grade, yeah, and which is rated, externally rated. So this by nature is limited. At the same time, what we observed at many points in time is that the fact that we support this part of the market, that probably frees up part of the portfolios for other type of issuers that are not directly supported, and therefore you have a positive spillovers to issuers that are not ECB eligible, but would have indirect support. The thing I wanted to mention, perhaps also in response to Alberto, is this point that you made on the fallen angels point. So what we have decided, it's not in the purchase program, but it's part of the collateral framework. Yeah. So the collateral framework is this the assets we take as a guarantee for the lending operations and the teltros. So there we decided that we would safeguard the level of ratings that prevailed in April. And therefore it means that the loans to these companies will continue to be eligible. So it's I think quite a powerful counter-cyclical tool, yeah, in order to avoid any pro-cyclical impact. But so far we haven't taken this step in the purchase programs. Now coming back to the teltros, I think one thing that is important to keep in mind is the teltros, they probably take time to be deployed. So when a lot of banks took liquidity in June, but for them to find the corporates to lend this money, and it was a lot of money, it takes many months. Yeah. So I wouldn't conclude now already about the fate of the teltro, but the important thing is that the incentive was there, meaning that, to your point of saying, well, what's the risk that part of the money ends up with more being lent to mortgages or to governments rather than being lent to corporations? Well, I mean, the teltro is a conditional operation. It's an operation where if you don't meet a certain level of lending to non-financial corporations, and if you're lending to somebody else, you will not meet your target. And that means that the liquidity you get will not be at -1%, but it will be a much higher rate, which is -0.5%. Yeah. So I think that with this, it's a huge incentive, 50 basis points. So I think that we should wait a little bit to see exactly how the teltros were used and to conclude. But the incentives at least are there to focus on the non-financial sector.
Thank you, Imen. I mean, clear replies. I had a question in the meantime from a participant who asked, but that probably could be for you, but also for Alberto, also probably for Raul, in the asset allocation. Since we know, let's say, that yields are so low, could this lead institutional investors more into the credit space or into more the risky credit space?
I guess maybe I'll start with that. So currently, if you take $80 trillion of global bonds, only 10% of that yields more than 3%. And only 5% of the 80 trillion, so the global bond market, yields something more than 5%. So if we have an inflation rate of 1 to 2 in the developed market, Europe is probably lower, US is closer to 2. It means you only have this 5 to 10% of the bond market where you can offset the inflation rate. Everywhere else, you're getting negative real returns. So yes, we are seeing a shift from sovereigns, investors that only do sovereigns, to buying agencies, to buying quasi-sovereigns, going into, or for example, from developed to emerging markets. However, it is hard for many investors to jump from investment grade to non-investment grade, or from rated to non-rated, because many investors, and this is part of the pension fund and insurance regulation, many investors are constrained by ratings, and sometimes not always rating are a good reflection of credit risk. So this essentially creates a bifurcated market where everything that has investment grade ratings trades at negative yields, while, for example, if we think about mid-market European firms during COVID, they have been issuing at double-digit levels. I'll give you an idea. Finnair, the Finnish airline, has Finland is AAA rated, has issued a subordinated bond which was not rated, and they had to roll from a previous bond that was maturing. This was 2 months ago. They paid over 10% for that bond. So we're happy to be funding these companies, because Finnair is in large part owned by the government. But it's also, from a transmission mechanism point of view, you may find that while Republic of Italy pays very little, and investors are trying to move, or Greece pays very little, and investors are trying to move lower, there's a big gap between investment grade and non-investment grade, and also between rated and non-rated, and many institutional investors can't do that the jump. So unfortunately, that remains a challenge, and bridging this gap, making markets more liquid, helping firms to borrow in the bond market is still a big challenge in the long term, in my view.
Thank you, Alberto. That brings me back to Raul. What has been your experience with institutional investors? I mean, were they interested? Were they interested in the yields you give? I mean, just to continue, let's say, the conversation which we had with Alberto, because Alberto sees, let's say, there is still a big problem.
Well, in our experience, what I can say is that in the commercial paper system, for us, we find little attraction to be rated, and we find little attraction in trying to find additional investors, because we tend to be comfortable enough about the low prices under which we are issuing commercial paper, and maybe that could be dangerous for small companies like us. Okay. And just to give you a reference, our next step in this process of education where we are, our next step is to be rated. Okay, but all I can see now in our small experience is that there is not many difference between investment grade, not investment grade for commercial paper for companies like Vidrala, and between being rated and not being rated. This is probably basically because of the extraordinary conditions that we are seeing in the commercial paper system. And okay, that explains in our experience that we need to keep us motivated. The next step is to be rated, to keep on being more sophisticated and more prepared. And okay, for the specific case of Vidrala, we will be rated as soon as possible.
Okay, thank you, Raul. There was a question for Iman. We had another question which came through about Iman mentioned the STEP label, which is something Raul mentioned, the issue about the need for documentation and standardization of documentation of issuers. The STEP program, Iman, which you mentioned, could be seen as a way for mid-sized corporations to find easier way to the commercial paper program. Do you see this happening? I mean, you mentioned the number, but that's still very low at the moment. Let's say those who have taken up the step, correct?
So this STEP program, as you mentioned, is a kind of way to how to say, have a more transparent, more integrated market. And the ECB has been supporting this label, which is administered by EMMI. Yeah. we found back in March and April that actually getting 30 of these companies to file into this label in 2 months was not too bad. Honestly, it was much better than what we had observed in the previous years. Yeah. Now, of course, you're right that this process by which the companies need to put together documentation, provide disclosures, just get used to provide more information to the market in a public way. I think this is difficult for some companies, and we see that because they are used to be, to keep this information for them, for their banks, and not put it up in the public domain. But I think a lot can be done in terms of accompanying them to do that more, because as Raúl explained, this is very rewarding to do it in terms of diversifying the sources of financing and also keeping financing costs low. Yeah. So I think more can be done on that. And sometimes it's just about, the need of hiring a law firm to help. Yeah. And what are the different steps that you should follow? So I see a lot of potential in general for, either the ones administering the label like ECMI, or for also, we were in touch in March and April with the Association of Corporate Treasurers in Europe, which helps for some of these corporates to take these steps. And I think that's something that should be done more and more.
On this issue, we had in the first session, we had John Berrick, Director General of DG FISMA, who was speaking about the single access point and also increasing disclosure for participants in capital markets. Do you find that, for example, in your program, that differences in accounting standards are still a problem? Because for non-listed companies, in principle, the national accounting standards apply. Is this an issue which hampers disclosure?
I can't speak for the broader market, but for our requirements, as I said, we don't look specifically at at the accounting requirements. Yeah, so that would be a bit too granular regarding the program. Yeah. But you can see that the demand of the market in general for disclosures is getting higher. And I think, the next frontier on disclosure is probably coming also from the ESG standards, and what's happening in I'm sure you touched upon it today, yes. on the standards that have been promoted by the Commission and others in terms of disclosure for environmental, social governance practices. So this I see as a real challenge now for the market for the next 5 years or so.
Indeed, we touched upon it in the previous panel, and of course in the context of rating agencies as well. And the Commission is working on a big study on non-financial reporting, and will on the basis of that propose, I think in the course of next year, a kind of a form of standardization for non-financial disclosure, which I think will be a big thing, but will be, on the other hand, extremely difficult. Any comment from Alberto or from Raúl on the issue of disclosure, accounting standards, also interaction with investors on information they want to get? Raúl?
Yeah, if I may, Carol, all I can add is, okay, in our example, this is part of the emotional cost or emotional limitations that I mentioned before. All I can say is an invitation for companies like us, companies of our size, to try to test and to open this door. Okay, we all tend to be very afraid of things like documentations, credit ratings, accountancy is much easier. At least the commercial paper system is much easier than it looks.
So you really make an invitation or a kind of a full publicity for a commercial paper market, and you say basically it's overestimated how difficult it may be. It's underestimated how easy it is.
Yeah, totally.
Very good. Alberto, you wanted to comment on that because you're also looking at that form of commercial paper from your company?
We actually don't do that because the yields are very low. So we tend to focus on higher yielding and potentially riskier issuers. So it is true that if you have good credit quality, good revenues, and you may not even want to be rated because investors perceive you as an investment grade issuer. But if you are, for example, an automaker or an airline or a cruise company that is more cyclical and today is facing some issues on revenues, then obviously we don't want investors to buy. For sure, we don't want investors to buy, or the central bank to buy this paper and face losses. But what we don't want to have is European companies to be at a disadvantage, for example, compared to their US competitors, because European capital markets are not as developed, or because they are weaker or more fragile. And I think that when it comes to European mid-cap issuers in the loan market, but also in the bond market, what we see is that there's always a liquidity premium of between, and we're talking about high yield rated names, so double B or single Bs, which are again most of the SMEs equivalent, whether they are rated or not. That's effectively their credit risk. There's a premium of 50 to 100 bips compared to dollar issuers. So the dollar market is more liquid, and the good news is there's been a lot of new first-time issuers in the market, thanks to the fact that the market has become deeper. There is more search for yield for investors going a bit outside of investment grade into double Bs. But there's still a risk premium that European firms tend to pay in the bond market. And similarly, I would say even in the bank market, in the bank loan market, because of the fragmentation that banks have, very often the cost of lending or the non-price conditions of lending, so collateral guarantees that banks ask, are still relatively high. So unfortunately, we're still in a situation where there's a lot of people that want to lend to the Republic of Italy or to Greece or to Spain at zero, but we don't have enough people that want to lend to the national Finnish airlines unless they get paid 10%. And here, I mean, I can make a few other examples, but essentially these are companies with government support. So imagine if you are a maker of auto parts in Italy, or if you are a fridge maker in Greece. So these are companies that if they can single B rated, if they can, I'm not going to make names, but they're going to issue at double-digit levels. So this is I think the situation. When things are good, when you are a good name, everything is great. Yeah. When you have a bit of trouble and you're single B, you're smaller, then you have a smaller pool of investors, and the backstop is a little bit far away. So the danger is here that the danger that we face is that we risk making the strong stronger and the weak weaker on a relative basis. That is something that we don't want. We don't want to increase inequality at the corporate level. Large companies making their owners billionaires and smaller companies not going anywhere. That's the danger that we face.
Thank you, Alberto. I could probably run the result of a survey or a poll which we did with the participants on how they think, let's say, to what should be used to facilitate financing conditions of corporates, and you have it here, say, and the number of people who replied. There were 41 people who replied. Let's say, so what can alleviate these pressures? Is it monetary policy, fiscal policy, banking sector solutions, or capital market solutions? And you see very clearly people believe it's capital market solutions. And I think it's a bit the thrust of how this discussion came out here in the end. Let's say that it's these issues like documentation, also awareness, what can be done through the capital markets, which disclosure and so on, which can facilitate this. The other things are probably a bit less important. Anybody who wants to, as a final round, let's say, to comment upon that? Or Imen, I mean, you see, it's the capital market solutions which matter.
Well, I'm glad that this is the case, because we don't want people to, also depend too much on the central bank. And I think that, as Raul explained, the fact that corporates, take their destiny into their hands and act on it seems to us a very good thing. One final remark also, and question perhaps to Alberto, is to what extent the premium that you are mentioning also depends on the depth of the investor base. Yeah, I mean, there is the fact that in the US there are institutional investors, so asset management, pension funds that have been there for a long time, have deep pockets, and also with part of this focusing a bit more on the high yield market. It seems to me there's also in Europe some structural work to be done on really the investor base, the institutional investors. So basically developing this as well in terms. So it's not only the issuers, it's also the investor base.
Yes, that's right. So if we think about it's also a currency and a currency market issue. So, European capital markets being smaller and the euro being a reserve currency, but not as big as the dollar, means that, euro denominated issues very often tend to, in the non-investment grade space, very often tend to trade at a premium. It's hard to understand the causation, but at the moment, what we see is that, European savings, there's a lot of savings from European families, households in fixed income. These savings go into the bond market, in the investment grade and in the high yield market, and they go to the US because 80% of all the top 100 asset managers is US based. And then this money gets redistributed and invested, and a lot of it goes in dollar assets, which include US assets, and then emerging market assets, and then European assets sometimes come third because they are in a different currency, and the portfolio manager from New York or Chicago doesn't follow the European market as well. So in part, it is a problem of how the pipes of the financial markets are where the pipes are. So there's a smaller market in Europe. Maybe as a result, or together with this, you also have less investment. But the interesting point is we have a lot of wealth in Europe in terms of savings. We have some large asset managers, but we could manage more of our own wealth and invest it more in our own companies. And in fact, some countries have created incentives to do this. Like, for example, in Italy, there's been some tax deduction to invest in SMEs, and this is a fiscal measure to encourage savings to help real economic growth in each European country. So all these things, we're not saying the ECB should solve all problems here. Sometimes there is the temptation that with the monetary policy button you can save the world, but these are micro issues. Structural market issues. They're not only monetary policy issues, but there is there is a lot more work to be done there. I agree with you with developing not only the capital market itself, also the investor base.
Indeed, Alberto, this is something we at ECMI have a lot focused upon. Let's say there's too much money on the deposits or on the banks, and there's not enough money invested in funds, which will be maybe, or certainly these days should be much more performing, let's say, than bank deposits. Raul, any final comment from your side? We just run a bit over time.
Well, yeah, just my final comment on that is that this is also part of responsibility of us companies in the real economy to understand, now learn, and try to access credit markets. For example, commercial paper, this is only a starting point, but it's our responsibility to take care of all the benefits that the current credit market conditions are offering to companies in the real economy like us.
Okay. With this, thank you very much, Iman, Alberto, and Raul. I think that was a very interesting panel to conclude our ECMI Annual Conference. Also very practically oriented, not putting the burden on the ECB. Iman, no, it was rightly said by the two others. No, it's the investors and the investor base who have to know what they're doing, and also the corporations have to try to benefit from that and not to hide behind complaints that things are not working. No, apparently it can work if the willingness is there. So I would like to thank everybody for their participation today. It was a very useful set of sessions where we have learned a lot as well about what the Commission is doing, what the rating agencies are doing, what the corporations and fund managers are doing, what the ECB is doing. I would like to thank all participants for their input, for their patience to listen, because of course in a virtual mode it's not always so fun as being in a real conference. I would also like to thank the sponsors. As I said, let's say we're working together with Brave and Howard Center from Imperial College in London and CFA and the AFME, who has sponsored this conference, and we will have very brief summaries of the different sessions posted next week online. If we could, Alberto, or eventually Iman, post also your presentations, that would be useful because sometimes there is a demand for that. So with this, thank you very much, and I hope we can stay in touch and count upon your participation another time. So again, thank you very much, and see you next time. Thank you also my colleagues from ECMI and SEPS for making this possible, Beatrice, Willem, Cosmina, Apostolos, and others. Thank you very much. Bye-bye.
Thank you.
Thank you very much. Bye-bye.
Have
Have a great weekend.
Yes,
Thank
thank
you.
you.